Hi, Tony Daly here, and I'm going to take you through Thinkorswim. And this is basically going to be how I look through and how I teach where to look for your strikes and how to look at the risk of a particular trade and how the kind of like the whole thought process behind it. So here we're looking at the IWM. And it really could be anything, but I'm looking at the IWM and I'm seeing, of course, it's been in an uptrend. We've had some pullbacks here to the moving averages, but every pullback was met by a buy immediately. So no pullbacks are being sustained. So anytime it moves back to any sort of support level, probably until things change, it's a good idea to just be buying all these dips or playing the appropriate option. Looking at the Analyze tab, we taking a look, and we are going to look to build trades and see how to read these things. So the first thing that I want you to be aware of is up here we can put the price of the underlying, and in this case it's IWM, and if we slide all the way across to the right we have a yellow box with a triple M in there, and that's called the market maker move, and that is specifically the anticipated move that's based on the current volatility that the market makers are pricing into the current option. So in this case it's 80 cents, and that's just for the 1 day. As we're trying to build options, very important to take a look at the option statistics, and right here the current IV percentile. For selling options, I've kind of made it a rule for myself that I want to be selling premium when the current IV percentile is above 50%. The reason is because then it's premium rich and I could widen my strikes a little bit, and when you have your mean reversion, the volatility should come back to the norm. So in this case it's actually below its median. It's down at the 18 percentile risk. So let's explore that and see what that means. So we look at the 52-week IV high, which is 25%, and the 52-week IV low, which is 14%. The current IV percentile is at 29. That's the historic. Implied volatility right now is at 16%, which basically is in the 18 percentile. So if you look at implied volatility is 16%, its 52-week range has been between 14 and 25. So basically we're saying that the IV percentile is at 18%. So basically I want you to think of it as implied volatility. When you're trying to say is it high or low, you're not looking at the current implied volatility to determine that. It's basically, is it high or low relative to itself or its own history, if that makes sense. Okay, then I take a look at the call and put ratio here, and we could see that the total volume is very, very close, 198 and 208. So that's not really anything I could derive from that, but I think a lot of people are basically, maybe starting to hedge a little bit by looking at buying some downside protection. So we just know this is 208,000. We don't know if they're buys or sells, but I know with the lofty levels here, I would be looking more to hedge the downside a little bit. So anyway, let's take a look at an option and how to read this. So we're going to, for now, we're going to ignore the weeklies for now, and we will be getting into the weeklies, but just for terms of reading this and how to use it, let's look at these are all the different strike prices, and the reds are weeklies, and then we have the monthlies, and then we actually go into leaps where you see how many days there are, and you could go all the way out to January to 2015 and 2016, but a little bit closer to home we're looking at December of 2013. The 34 represents the days to expiration. And if we go across all the way, we could see this number right here represents the implied volatility for December 13. That's the third Friday in December expiration. It also is going to give us the implied based on the implied volatility, that's giving us the expected move. So that would be a 1 standard deviation expected move, which basically says that 68% of the time IWM will move $4.58 to the upside or the downside. Now we could use that when we decide on what type of options that we want to place, and where we set potential support and resistance, and we're kind of getting an idea of the expected move and the odds of it making that expected move or staying within that expected move. Every type of option strategy has its own thought process and analysis behind it, but you have to have an opinion to begin with, because once you have that opinion, you could construct one of the various option strategies based on that opinion. So let's open up December and see what it's telling us. I have all of the strikes here. I'm going to take some of these off. We're going to go down to 14 strikes. The shaded represents in the money, and the dark is out of the money. So we could see on the call side on the left, and we have the put side on the right. These are the various strike prices, and if you notice, they're only $1 wide. Okay, so the difference between $1.10 and $110 and $111 is $1 times, now you know one option contract equals 100 shares, so you could think of each one of those strike prices being $100 apart. It's $1 apart times 100 shares, so you're basically looking at $100 per strike. Okay, and this one actually gives you only these are called penny increment options because they actually trade in pennies, and they're dollar wide. So here's what we know. We know right now that the price is $110.92. So if we were to look to buy this option right now, we could see right down here, and I'll move this up for you so you could see a little bit, that we were to buy IWM. The strike price is 111, which is right about at the money, and that would cost us $1.98. So, or $198. The volatility is 15.29%, and the delta is 48.94 or 49. And that basically, the delta is telling us two things. It's telling us that it's basically like a 50-50 trade, that the odds of this option expiring in the money right now is 49%, and which means that the odds of it not is 51%. So basically it's 50-50, pretty close to stock. And it also tells us that if the price of the underlying, in this case IWM, goes up $1, the price of this option is going to go up approximately 50 cents. So you basically have a 1-to-2 relationship between the option price and stock movement. So here we are, we're looking at the ask price. So here's the $1.98 we're going to spend. So how do we figure out what our break even is? Well, since we know it's 111 is the strike price, we know that it has to be above 111 to have any sort of value, because just expiring at 111 doesn't cut it, because that's basically at the money, so it will have no value. We know that this $198 is going to decay, and it's going to decay every day. So let's take a look at what these Greeks tell us. So here we are. Just pay attention right now to the reference of the middle line. The middle line is the delta that we talked about. Gamma I'm not going to spend too much time on, but gamma is the acceleration of deltas, which becomes very prevalent and important as we get closer and closer to expiration. The theta is minus 2.78. Whenever you see a minus, that means it is going to lose $2.78 between now and tomorrow. So if everything is equal, this $1.99, this $198 that we pay will be worth $2.78 less. So if the stock price doesn't move, the theta will slowly erode. So that's basically telling you that this is a wasting asset, and eventually it's going to be worth zero. So as an option buyer, you need this product to move. The Vega is the implied volatility movement based on 1% increase of implied volatility. When it's a positive number, that means this position will profit on an increase in volatility, and it will consequently decrease if implied volatility goes down, and $13.67 represents how much the price of the option will go up based on a 1-point move or increase in implied volatility. I know this is a lot of information, but I'm just kind of giving you an overview, and you could look at this a couple of times to help you out. So let's get back to the strike price here. So our break even is 111, which is our strike price, plus the amount we pay for the option. In this case, it's $1.98. Let's round it to $2. So I basically need this product to be at 113 just to break even by the third Friday in December, which I know has only 34 days to go. So I know the expected move is 4.58 points. So basically, two of those are going to be eaten up by just what I need in time premium. So I'm not looking at that mammoth a potential gain here, and any gain that I'm looking at has to happen relatively quickly, otherwise my theta is going to start to erode it. So let's look at what else this tells us. So here again is the delta, and then here's our probabilities. Our probability out of the money is 53.4%. which conversely says that the probability in the money is 47%. So we need our product to be in the money to profit here. So this is basically about a 50-50 because it's at the money, and we know it's going to erode $2.78, and we've kind of gone through the entire thing. We could also take a look at probability analysis and risk profile, which we're going to do on another video. So I'm going to just go another couple of minutes, and I would like to show you one different thing here, just as a comparison. What I'd like to do, just to show you the difference, is let's go out of December and let's go into January. So now we're moving out 62 days, and what we're going to do is we're going to look to buy the same call. Now I left this one up here as a comparison. So the only difference you're seeing here is this one has a strike price of December, this one has a strike price of January. This one is $198, and this one is $265. Now, I'm sure my question to you would be, why is it more money? And the obvious answer is going to be because of the time premium, the difference between 34 and 62 days. You basically have more time for this to finish in the money. The expected move, if we take a look at this, went from 4 to 6. So we're basically saying in the difference between December and January, this has the potential to move an additional 2 points. And again, that's based on that one standard deviation move we talked about, or 68% probability. Okay, the other information here is the probability in the money and out of the money basically kind of stayed the same, but let's take a look at our Greeks here. We have the same delta, which is basically saying it's about a 50-50 proposition. Gamma becomes less of an issue the further from expiration we go, so we don't even have to talk about that too much, but let's take a look at theta. If you remember, the theta of the previous was $2.78. With this one, it's $2.04. So time decay is less the further away you go in time. So as an option buyer, that works for you because you have to consider you need as much time as possible for this to start, to give it the time to move in the direction you need it to move in. You're also going to pay more for this. This one is $265 versus $200. So your risk is capped at $265, and if it doesn't move in your direction, the theta and the probability deltas are going to start moving against you, because if it doesn't move,